Billionaires always see a storm before it comes, and it just happens that the biggest storm of all time is coming. CEOs, hedge fund managers, and venture capitalists worldwide are preparing for one of the most serious crises in history. Many actually think that we're already in a recession, but the world just hasn't realized it yet. This video will unravel the strategies that are being used by billionaires to hedge themselves against the upcoming downturn and how you can as well. Most people assume that timing the market is impossible, and that's true for the most part. Timing the market is extremely difficult, but you don't need to know the exact timing to prepare. Billionaires frequently implement strategies that hedge themselves against incoming crises. By hedging their wealth, they will succeed in any situation. In the scenario of a crisis happening, those who hedge their wealth will be the only ones with their heads above the water. Take Elon Musk's strategy as an example of this. Elon believes that we are already in a recession that could last from 12 to 18 months, but he isn't trying to time the market with his stock holdings. Instead of being 100% certain that a crisis is coming, he looks at the future as a probability. Economic landscapes are fluid, and you should never be binary as to whether a crash will occur or not. Rather than going all in on his economic prediction that could be wrong, he's simply just hedging for the worst outcome. How do you assess our current economic situation? Well, predicting macroeconomics is always difficult, and one should assign probabilities to these things. But ironically, I did last year. People asked me what I think about the economy, and I said, well, I think we might enter a recession in approximately spring of 2022. Called it. Nailed it. Yeah. Actions speak louder than words, and Elon's actions are no different. He recently decided to lay off 10% of salaried Tesla employees in preparation for a macroeconomic disaster. The reason why Elon is laying off employees is for capital preservation. It might not seem like cash is important during an inflationary period, but cash flow is king during recessions. This not only applies to businesses, but also retail investors like yourself. The Federal Reserve has overextended its balance sheet by over $5 trillion and plans to reduce the money supply over the next couple of years. This means that the Fed doesn't have the leeway to hand out free money like before. If the economy crashes in the coming months, money will become scarcer even if inflation remains elevated. Elon already experienced the scarcity of money during the dot-com bubble, and he highly advises businesses to get their hands on cash while they can. 100 million in March of 2000? So it was like there was literally fire hosing money in March of 2000. And then in April 2000 the market went into free fall, and it went from raising money was trivial to, even good companies could not raise money, in a month. So it's just important to bear in mind that PayPal almost went bankrupt in 2000, came close. But thankfully we'd raised that $100 million in March 2000, without which it would have been game over, basically. While Elon is one of the leading innovators, he's not the only one laying off employees. Peloton fired 20% of its workforce. Carvana cut 12% of its total staff, which totals to 2,500 employees, and Coinbase paused the hiring of new employees, withdrew existing job offers, and laid off 18% of its workforce. All of these layoffs have one similarity: macroeconomic concerns. Coinbase cited current market conditions as one of the primary reasons for its layoffs. An article written by the Chief People Officer of Coinbase, L.J. Brock, explained how adapting quickly and acting now will help us to successfully navigate this macro environment and emerge even stronger, enabling further healthy growth and innovation. We've talked about how businesses need cash flow to survive, but this also applies to people like yourself. Think about your monetary inflows and outflows like a business. You have income flowing in and expenses flowing out. By subtracting your expenses from your income, you can calculate your operating cash flow. Now take that operating cash flow and subtract your taxes to get your net cash flow. Although your cash flow might be positive right now, it could easily disappear in the coming months. That's why we have to focus on capital preservation. There are a vast array of methods to hedge your portfolio against market downturns, many of which I've covered on this channel. One of the most well-known methods is to simply short the market. Carl Icahn manages over $21 billion as an activist investor, and lately he has been shorting the market. Icahn is known for being a corporate raider. This means that he frequently takes over companies and sells them for a profit by stripping the companies of their assets. Even though many dislike Icahn, he is certainly one of the greatest investors of all time. He averaged an annual return of over 26% from 1968 to 2014, which is considerably higher than Warren Buffett's returns. Icahn went on CNBC earlier in 2022 to describe why he believes there could be a recession or depression coming soon. Icahn uses a volatile strategy, which means that he has to hedge his portfolio against considerable downturns. Carl Icahn has been purchasing credit default swaps on mortgages of corporate offices and shopping malls. Purchasing credit default swaps is equivalent to shorting on steroids. By purchasing credit default swaps on corporate offices and shopping malls mortgages, Icahn is essentially shorting physical stores. This acts as a hedge against his long positions. Remember that hedging doesn't mean that you're timing the market, it simply means that you're protecting your portfolio for the worst outcome. Well, we have a very large position on shorting the malls through the CMBX through a derivative, and that whole market is a huge market. The market itself, I think, is manipulated to some extent, and you're going to be hearing from us on that in that area. But that is an area that I think has problems, and certainly in the B and C, malls and in other real estate. You can't ignore the fact that, and I don't know if this is a change that will continue, but you don't have people go into offices all the time anymore, obviously. And I think that is going to militate against the real estate area, perhaps. Icahn is shorting an industry that is outdated and in the process of being disrupted by innovation. Another billionaire fund manager named Leon Cooperman is implementing a similar strategy. Cooperman averaged an annual return of 12.4% from 1991 to 2018, which is over 3% more than the S&P's average return. Similar to Icahn, Cooperman also foresees a recession and is currently 68% net long. This essentially means that 68% of his portfolio is long on stocks and the remaining 32% is shorting the market. Although a lot of billionaires are hedging through short positions, many of you are likely not comfortable with the risk of shorting stocks. Cooperman himself has said that purchasing stocks is historically a strong hedge against inflation. Before initiating his short position in April 2022, he actually called himself a full invested bear. This means that despite calling for a bear market, he had no short positions whatsoever. So instead of shorting the market, he was actually just holding stock to hedge against inflation. Another popular hedging method is to purchase short-dated put options on your existing stock holdings. Cooperman has publicly stated that he has put options on Microsoft, Google, and Amazon, despite having long positions in all three companies. This allows him to be protected against a short-term sell-off while still being positioned well for the long term. His put options are a hedge against short-term downturns, while his stock holdings are for long-term gains. Some investors might think this is pointless, but you have to put this into the context of beta and alpha. Beta is the volatility of your portfolio in relation to the stock market. The S&P 500 has a beta of 1. If you have a portfolio that is 2 times more volatile than the market, then that means your portfolio beta is 2. If your portfolio is half as volatile as the S&P, your portfolio's beta is 0.5. Alpha is a risk-adjusted return that subtracts a factor of beta from your return. This means that it accounts your return for volatility. If your portfolio has higher volatility, then your alpha goes down because you're subtracting beta. This also works on the other side. Lower volatility typically equates to higher alpha. High alpha is what fund managers strive for because it adjusts your returns for the risks that you're taking. By having hedged bets like put options against long stock positions, Cooperman is increasing his alpha. Billionaire fund manager Chamath Palihapitiya is also preparing for a stock market crash. He believes that those who go for alpha instead of beta will be the only survivors of the upcoming downturn. We made a sub-economic decision, like the idea that over the last 4 or 5 years you optimized for anything except the market beta was kind of dumb. And the worst thing that you could have done in that period was confuse alpha and beta, meaning alpha is what you are able to do because of your discrete skill versus anybody else. Beta is when just the market goes up. Said differently, you could take any NBA player and put them on a high school basketball team and they would be the college player of the year, any single one. That's beta. If you then can be the MVP of the NBA, that's alpha. Yeah. Okay, and I think that a lot of folks were made to feel very silly or downer or a wet blanket in these last few years who will probably have the last laugh. Another fund manager named Jeffrey Gundlach recently launched a fund that aims to tackle the current and future economic issues. Gundlach manages over $140 billion through his mutual funds that have consistently beaten their respective indices. Gundlach's newest fund is called the Double Line Chiller KPTF. The CAPE ratio stands for the cyclically adjusted P/E ratio. This ratio essentially adjusts the P/E ratio for cyclical fluctuations and earnings. Gundlach is using the KPTF to find the most undervalued sectors in the market. The reason why Gundlach chose the CAPE ratio is because it divides the price of a stock by the company's 10-year average of inflation-adjusted earnings. This allows him to ignore short-term earnings fluctuations and effectively pick out the long-term winners. These long-term winners are those that have stood the test of time regardless of the broader economy. The last hedging method is to simply diversify your portfolio. This is most commonly used by Ray Dalio, who is known as the king of hedge funds due to his focus on alpha. Through his allocation that includes almost every asset, he's protected in almost any macroeconomic environment. This chart lays out the assets that Dalio holds in his fund. The y-axis is inflation, which increases and decreases as it moves up and down respectively. The x-axis is the US GDP growth. You can see from this graph how Dalio includes assets that perform well in any macro environment. So his fund is essentially macro neutral. By adding more asset classes he'll be able to increase alpha by reducing volatility. This is because you're adding uncorrelated assets out of similar, if not the same long-term returns. Dalio calls this strategy the Holy Grail because it's the key to succeeding in the hedge fund space. Billionaire hedging strategies all differ in their own ways. And it's our choice as retail investors to choose the one that suits us best. In this video we've talked about initiating short positions, buying put options, purchasing inflation-resistant stocks, allocating capital to time-tested companies, and diversifying your portfolio. Investors can choose one of these strategies or even use a mix of them in order to maximize alpha. Remember that it's usually never a good idea to time the market. Timing the market is notoriously difficult and would involve either going all in on your positions or simply holding 100% cash. Both of those are historically losing strategies that typically lead investors to lose all their money or miss out. Let me know if you'd like me to do a deep dive on any particular strategy. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.